Hi, welcome to Rounds and Returns, where we provide practical and evidence-based financial and investing education for medical professionals like yourself. I'm Dr. Jeff, a practicing internal medicine physician who's been investing and managing my own real estate portfolio for the past 8 years. In this video, we're going to outline the benefits of investing in real estate and the different ways that you can do it, and what might be best for yourself based on how much time you really want to commit to it. Thanks, and let's jump right into it. So the outline today, my goal was really to just cover every basics of real estate. So we're going to start out with why is real estate, what's the point of investing in it, what's the benefit of it. We'll talk about everything from passive investments, things that aren't going to take a lot of your time. We're all doctors, we're all really busy, and so passive investments are really good for a lot of us. Then what I call kind of the semi-passive investments, a little bit more time consuming, but why there's benefits to it, and then get to active. So there's residential, there's commercial. Diversification is just so that you have more things in your portfolio. So when your stock market portfolio goes down, your real estate should still be making your money. Yes, if everything in society collapses, it will go down like it did with a terrible crash, but it's going to be better. If the stock market loses 40%, your real estate probably isn't. And then leverage. We'll touch on leverage in real estate, why you can leverage your money to make more money versus why leveraging in the stock market is not as helpful. Most passive one is a REIT. It gives you real estate exposure. So it's a real estate investment trust. It's basically an exchange traded fund. So anything you can invest in your taxable account, in your retirement account, you can buy REITs. They're really easy. It's basically a company that's a publicly traded company that's purchasing real estate, financing the real estate, investing and managing all their own assets. Really easy. You just go online and you purchase it and you're done. It's really passive because it's a purchase and forget. You don't need to really look into these companies that hard. You don't need to look into the deals they're doing. It's very simple when it comes down to it. You're very liquid. Any moment, if you want to take your money out of a REIT, you could do it within 1 to 3 days. All your cash is now out of the market and you have cash again, which is very different than most of real estate, where you're going to be stuck into some asset for a really long time, years usually. And then the next is that you can invest any amount. There's not that barrier of entry. You can put $5 into a REIT, you can put 50 million into a REIT, anywhere in between. So there's a lot more options that you've got out there. Big negatives of it, unlike most real estate, it's more correlated to the stock market. When the rest of the stock market goes down, REITs typically go down a larger proportion than the rest of real estate market. So you are going to have that little bit of correlation there. You don't have any control over it. Whatever this company wants to buy, whatever they want to sell, you're just kind of stuck in what they're doing. A lot of times I put the cons as a high dividend. So they're going to be paying out, a lot of them have to pay out at least 90% of their profit. They have to pay out to the people that invest. So that's coming out as a dividend. If you have that in your taxable brokerage account, you're going to be paying your normal income tax rates on those dividends. If you have it in a tax deferred account in your retirement, those are going to be tax free or tax deferred for whatever length of time until you use that money. But it can be detrimental depending on where you have these REITs and where you purchase them. They're really easy to buy. There's a number of them that are out there. Vanguard, this is one of the Vanguard ones. You can go on Fidelity, Vanguard, any brokerage account you have, you can go and look them up and buy them. One of the more common ones, this PLD, just done really well over the last 5 years, so that's why a lot of people have been buying them. Lastly, there's ones that focus, REITs that focus on specific sectors. So things like Vanguard, you're going to have a big exposure. They're going to do residential, multifamily, office space, industry. You can also get things that focus smaller. So like this company does just healthcare. So it's going to be hospitals, clinics, office buildings, only for healthcare sector. So you can really get down to nitty gritty in a REIT. You can have somebody who's just purchasing warehouses. So a lot of different options out there. As you get more active, so I call this kind of the less passive sorts of investments, crowdfunding. So these are the two most common websites people use for crowdfunding. So Fundrise, Yield Street, those are the ones you'll hear about just because they have the biggest market cap. It's like crowdfunding for any other sort of purchase. You are basically going in with a number of other people, provide whatever loan somebody is looking for. Somebody like me, I could go to one of these companies and say, I want a loan for $300,000 to purchase this building. You as investors can look at all these different deals, all these different people that are coming in and decide, I want to invest in this person, that person, this person. And you can really pick who you like, who you don't like, the deals you like. So as we get into the pros of it, it's a low cost of entry. Different companies, Fundrise or Yield Street or some of these other ones, they have different costs to get in, but some are as cheap as $5. So putting $5 towards one or $100 towards another real estate deal, it's really easy. You're not putting in $50,000 and really committing a substantial portion of your portfolio to one deal or another. You get to pick your own deals. So you get to select who's the operator, what they're doing, what their plan is, and you get to kind of evaluate who these people are and do you trust them? Do you want to go and invest with them or basically loan them money? You can diversify a lot. Most of these are people that are either flipping homes or buying residential real estate or smaller deals, but you could diversify over a number of different people and a number of different opportunities. Less market correlation. So really, we're starting to get more into the real estate that's not correlated to the stock market. Yes, it might go up or down, but it's going to be much different than anything else like a REIT that's a lot more correlated. The big negatives of crowdfunding, you're not liquid. So unlike the REITs, you can't take your money out at a given moment. You're going to be committed to whatever the term of that loan is. It's going to be 1 year, 3 years, 5 years, 10 years. They're different, but you're committed to them. And that's one of the negatives of it. There's a higher default rate. There's a reason why people are going to these companies to ask for money and not going to a bank. They are not the prime person who's going to have a great credit score, who has a great track record. So the default rates are higher. You're going to get a lot more return for your money. So the rates that these people are taking money out at is a lot higher. They're not getting a 3, 4, 6% interest rate. They're getting a 12, 15% interest rate on the money that they're borrowing. So there is a balance. Expect defaults, but you're going to get better upside as far as a higher return from these people. Regular income rates. Interesting. You have to manage a lot. So you're winding up doing a spreadsheet to actually know if you're making money doing these crowdfunding deals. So it's a little bit more work. As we get to more active types of things, it's going to be your syndications. So syndications, you are putting your money with one single operator. So one person or one company, and you're typically buying a lot larger deals. These are the people, if you ever look at 500 unit apartment complexes, the giant malls, these are typically syndicators. So it's somebody who has gone and gotten money from a pool of people to purchase this one property for 50, 100, 250 million dollars. The big benefit of it is you're buying a much better asset than you could do by yourself or you could manage by yourself. And so the returns are normally a little bit higher than it would be if you were just investing in something a lot smaller like a duplex. Not necessarily, but the goal is that it's a higher return. There's not that market correlation, just like the rest of real estate. That's why it's really beneficial. There's really no ongoing time investment. So you're going to be putting a lot of time into evaluating the deal that these people are coming up with. You're going to be evaluating the person who is doing the investment. Are they trustworthy? Do they have a track record? After you do all that initial due diligence, you basically hand them your money and you don't have to do anything at all. Your job is then to just cash the check that they send you and put this on your tax return at the end of the year. You also are going to get a share of depreciation. So this is kind of the first step in the kind of passive through active types of real estate that you get depreciation. And I'll talk about why depreciation helps, what it's good for, why it's such a great thing to have, and why that's one of the best things of real estate. But this is really where you start to get it. And you'll get your share of the overall depreciation of that asset. Big negative, it's the cost of entry. So like I said, these people are buying 50, 250 million, $500 million deals. They don't want somebody contributing $1,000. Typically, they're wanting $100, $200, $300,000 as their minimum to invest with them. There's a big initial time investment. So the benefit is that once you invest that time, you don't have to do anything the rest, but you really have to evaluate who these people are. You have to really look at the deal to see if it's going to be right for you, if it's going to work for you. There's a sponsor risk. So the person putting this deal together, you're going to be trusting them with your money. They have full control over everything they do with the building, with how they're managing it. And you are trusting that, one, they're not just going to take the money and leave the country, but they're going to take care of the asset and you're going to make money. There's not a lot of diversification. You're putting $100,000 at this one building. For most of us, if we're putting $100,000, $200,000 in one particular building, that's a big percentage of our portfolio for retirement, rather than a multimillionaire putting some basically pocket change towards these things. The other thing is you need to be an accredited investor to do it.
You do like a syndicate type deal where you have like 20 people with one property, for example, right? How does the K1 that you get for each person, how is it? Is it divided by, for example, the percentage of the property that the person, individual person owns? Like this guy owns 5%.
So
owns 10%. How does that work?
It can be. So the thing with syndications, everybody putting up the syndication can do anything they want with the property. So some of them will distribute the depreciation equally. So you have $100,000 of your $1 million building. You have 10%. You have 10% of the depreciation that kicks off every year. There's other people that'll say, our company is going to keep 25% of the depreciation and we will split the rest among everybody else. They could do a lot of different funny things. Everybody's going to be a little bit different. They can also pay out. Syndicators can pay out differently. Sometimes they will only pay out a certain proportion of the money until they hit a certain point, and then they will keep more once they return enough money to the investors. So it's really important to be looking at what they're offering every single deal. That's part of that like upfront evaluation and time.
And is that mentioned in the initial contract? That's sort of like TBD.
It should be when you're getting ready to actually sign with them to give them money. Before, when you're just talking to them, they should be able to give you these informations, their pay schedule, all of these things. But in any documents that you're signing, it should have laid out what their pay schedule is and what the agreement is.
Or the depreciation.
They should include their depreciation as well. And it might just be something as simple as it gets split evenly among all the members.
But evenly doesn't make sense, right?
Based on the percentage of ownership. A lot of times they'll do that because it's simple and people don't argue with it. Yeah. That's a good question. That's one of the tough parts about syndications, though. It's every company or every syndicator can do things differently with payments, with depreciation, with payback periods, all sorts of different things. There's a lot of different things that they can make it really complicated, pay schedules and money return schedules, or they can make it really simple. The other thing is you need to be an accredited investor to do it. To make $200,000 a year in 2 consecutive years, or $300,000 as a household for 2 consecutive years, or have $1 million of total assets. There's a couple other ways people can do it. If they're part of the company that's doing the investing, they're allowed to invest because they technically know what they're doing or know what the company's doing. And the other are the financial professionals. So people that are holding these financial degrees, Series 7, 65, 82. These people are considered, they know enough about investing that they can make a good decision. That's really what accredited investor is supposed to be all about. And that's why the IRS forces you to do this. It's that you have enough money to lose and you will still be okay. If somebody does take this asset down to zero and you lose everything, you still have money left over. You still have an income. And the IRS is saying, well, this person, you should have known better. You were smart enough to know that this was probably not going to go well. So the onus is on you. That's really where this accredited investor is. A little caveat to syndications are the people that are just going in together. If you know somebody and you're just pooling your money to buy a duplex, to buy a multifamily unit, the 4 or 5 people that come together, you don't have to all be accredited investors if you already know the people that you're investing with. You have a relationship before this real estate investment. That's kind of how you can get around needing to be accredited investors for your properties. Next is active. So this is kind of what everybody thinks of when they think of real estate. This is what everybody is afraid of doing. Everybody wants to do. This is where the big money is, the big returns are, the big headaches, all about active. So it breaks it down into a few different kind of components of active real estate. You can do turnkey. Turnkey is basically, there is a company that flips houses or renovates apartment complexes. They do all the work, renovating, remodeling. Then you just come and you buy it from them, and they stay on as the manager. So that's the turnkey. There's different companies that specialize in turnkey properties. So you're just going to buy their building they remodeled. The goal is that there's not going to be this high cost of repairs, and you have somebody who knows what's going on. So that's kind of the initial way to get in. Then you can get in with investing. You buy your own building, you buy your own duplex, you buy your multifamily building, but you hire a property manager to do all the kind of day-to-day work. So you do the evaluation of your property, you do all the due diligence beforehand, make sure it's a good deal, and then you pay somebody to do all the rest of the work for you. And then the last thing, this is kind of what I do, it's self-managing. You doing not only look at the asset, evaluate it, purchase the asset, and then manage it over time. Find your tenants, do your evictions, collect your rents, do the maintenance, or hire out any specialty contractor that you need to bring in. The three main types of real estate you can kind of invest in, it's residential, commercial, and then short-term or vacation rentals is kind of the caveat, the extra one here. And we'll kind of talk about why it's unique, why it's kind of special. So why do you want to spend the time? What's the benefit of putting in all this extra time instead of just buying a REIT, instead of doing a syndication? There's income benefits on one hand, and then there's the tax benefits. These are things that you don't get with the other forms of investing, which is why there's a definite benefit, there's a definite upside of doing all this work, putting in all the time. So I break it down into 5 different income benefits. So number 1 is cash flow. So the biggest thing is you are getting money in your pocket every month. So say you're getting $5,000 in rent, and then you have $7,000 in deductions. Now you take that away, you basically have $5,000 in your pocket, and on your taxes, you're still showing an overall $2,000 loss in your investment. So you're paying $0 of taxes on that $5,000 you made. Very different than most of our income is W-2 or 1099. We're paying 30-40% on every dollar we're getting. The next really big one is appreciation. So not a lot of assets that we buy appreciate. Cars depreciate. It's just going to go up in value over time. That's all appreciation is. The very cool thing is about forced appreciation. So this is why it's number 3. What you're doing is you're adding value to the property that you have. And so you're going to increase the value of that property by putting in something to it. So my example here is we spent $15,000 remodeling the kitchen in our rental property. But now, all of a sudden, instead of renting it out for what we had, the rent, we can rent it out higher because it's a better value. Getting another $250 a month or $3,000 a year. But if you have a 10% cap rate, you take your $3,000 of increased rent and increased value that you've added overall to your asset, you now added $30,000 of forced appreciation. The value of your building is now more. You've doubled it, your money. You put in 15, you get out 30 when you actually go and sell the building. Capitalization rate, it's calculation is the expected rate of return. Really, it's a made-up number of what people are willing to pay for that asset. You take a really nice apartment building in a really nice neighborhood, great part of town, cap rate of 6% is kind of that normal. If you take a terrible building in the slums, crime-ridden area, cap rate is 15%. If you look, you can really tell the difference. Cap rate is very important for your forced appreciation. So if you're in a good neighborhood, every dollar you're increasing in a good neighborhood, you're getting more value in that appreciation of your asset. Next on income benefits, so it's a hedge against inflation. You'll hear people throwing this out, that real estate is your hedge against inflation. Really, it's only a specific type. So only if you have a fixed rate mortgage for a long period of time is the hedge against inflation. The reason why is the rent that you're getting from your property and the value of the property is technically going to go up if the value of $1 goes down. So if $1 today has the buying power of $10 tomorrow, well, the rent that you're getting tomorrow should be higher, where that loan, that amount of money that you took out is still in yesterday's dollars. Leverage is the other one. You purchase a building, so you spend $400,000 in your purchase. You're putting 20% down, you're getting a loan for $320,000. Now, if your property value increases by 10%, you're not making 10% of return. You're actually making 50% return on your investment. You invested 80, it went up $40,000. You made a 50% return on your cash. So that's where the leverage is. Take out a loan and you buy stocks. The difference is if you take out a loan to buy stocks, it's a lot riskier that those can go to zero. And that's what was partially the crash in the 20s, was people were starting to take out loans. When the market went down, nobody could repay these loans. And that was the stock market crash. So leverage in real estate is great. Leverage in the stock market is very risky, and you're probably never going to get a loan. Tax advantages. These are the other really great things that you can get from real estate. So depreciation, we kind of touched a little bit on when you get to the syndication level as far as active investing, that's where you start to get some depreciation. Really what it is just a portion of the building that you can deduct. My example is if you're buying a residential, they're going to depreciate over 27 and a half years. So $500,000 property, you are getting a paper loss, is what we call it, of $18,000 and change every single year. Whatever you're doing with that building, you are losing, according to the IRS, $18,000 of value. Commercial is not as nice, written off over 39 years. So that same $500,000 property, you're getting $12,000 and change of depreciation compared to the $18,000. Whether you have duplex, a 5-unit apartment, or a 50-unit apartment, they all count as a residential building for this type of depreciation. There is a thing called bonus or accelerated depreciation. So instead of just being stuck with your 27 and a half years or your 39 years, there's a way to do it a lot quicker. You basically have to hire a company. You're paying somebody to do what's called a cost segregation study. They're anywhere from like $1,000 to $5,000, depending on how big the building is and how much work they have to do. But what they're really going to be doing is they're going to be taking every individual piece and part of your building and putting it basically in a spreadsheet. Instead of the building, so this building, for instance, being depreciated over 39 years, each one of these doors depreciates over 7 years. The carpet depreciates over 7 years. Every window that you see on the inside, the windows you see on the outside, the paint on the walls, they literally go and itemize everything of your building. They take square foot measurements of everything, and then they come up with this different schedule of things that you can kind of accelerate that depreciation. So one of the ways you can do it is some things you can deduct in the first year. So my example is if you do this bonus of depreciation, say you get $100,000. This company comes back and says, with all these things that we now have, you can deduct $100,000 in year one. Now the remaining $400,000 is what you take over your 27 and a half years, your 39 years. So year one, now we have $114,000 of paper losses to put against our income. It's a substantially different amount. Now, over 39 years, it will all equal out. The benefit is that you're kind of front loading all of these losses. You're front loading the losses. And there's a couple reasons why people like to do that and why they get benefit from it. My personal example is I sold a building. I had $40,000 of capital gains when I sold the building. When I bought this building, we did a bonus depreciation. I didn't have to pay any money that year on that $40,000 profit that I made because it was all wiped out by the losses that this building had year one. It was because I did it in one calendar year. I had all my capital gains that I made offset by my losses in depreciation of this building. So a 1031 exchange. The IRS calls it a like-kind exchange. People will call it 1031. People will call it a Starker trade. There's a ton of names for it. Basically what it is you are taking the sale of one asset and you're putting all of that money into this other one. People do it a lot with real estate because it's just the most common form, but you can do it with artwork. If you have a Picasso that's worth millions, you can sell that and exchange it for another piece of art that's of equal or more value. So we'll talk about kind of where that's helpful. You're deferring your capital gains. So instead of paying taxes on the capital gains, we bought for 500, sold for $1 million, 500 grand of capital gains, and you pay tax on that 500. This is you are rolling it into your next deal. And there's a lot of different rules in order to be compliant with it.
Is the name of the game do so much 1031s and then die so that your kids just get all of it?
Exactly. It's got to be a similar asset. It has to be real estate to real estate. It can't be you sold a duplex and you bought a Picasso, or the other way around. It could be a duplex and buy land. It could be this office building and I bought a 20-unit apartment. They count land, property, the real estate all as one entity. It just has to be one asset class according to the IRS. So we're talking real estate, any sort of real estate you can do it with. There's a lot of really strict rules. And that's the tough part about a 1031 or a like-kind exchange. It's the specific rules in order to do it correctly. One of them is it has to have the same entity name. My company is Jaybird Properties. If I sell one building and that's under this name, the name has to be Jaybird Properties as the purchaser of this next thing. I can't sell it under one name and buy it under another. It has to be that same entity or same owner name. It could be a business, and it has to have the same investors, but it has to be the same name. It has to be the same company, the same person doing it. It has to be for the full amount. If you sold a building for $500,000, you have to put at least $500,000 into the next property or properties. It doesn't have to be just one thing. You can spread that $500,000 out into 4 buildings if you want. It just has to be at least that $500,000 that's just the sale price of the first asset. You have to never touch the money. And this is the most important thing. When you sell the asset, the money is never yours. It is never in your bank account. You are never have access to it. You're basically hiring a third-party company that on the sale of your building, all of the money on that sale is going into a trust account that they are in charge of, and they are then going to give the money for the new purchase of the asset. So you have to hire a company to do it. So you're hiring this outside company that's managing your money, that's taking the money. There's a lot of them that do it. They charge anywhere from a few hundred to a few $1,000s to do it, but you're hopefully saving tens of thousands of dollars, if not hundreds of thousands on taxes. So it's definitely worth paying them $1,000. You're paying them such a small percentage of what you're potentially saving that's where the benefit is. If you're selling a building and you're making $10,000, it's not going to be worth 1031ing that into a new building. It's just not worth the value. You need to identify within 45 days. So from the day you sell your asset, you have to have identified what you're going to put that money into within 45 days. You can identify 100 buildings that are on the market and just pick one of them, but you have to have a list from the day at that 45-day mark at most that it's going to be into. And then you have to close on that new purchase within 180 days. So from the date of your sale, you have to have everything identified at 45. It has to be closed by day 180. It's really fast. If you bought a house before, you know it takes a while to look for properties. It takes a while to do your due diligence. You have to look for money. You have to get loans. You have to do an inspection. They're 2 weeks out. They're 4 weeks out. You get going really quickly. So these time constraints can be really hard. If you put this money into a 1031 company, so if you plan on doing a 1031 exchange and you back out, you just pay the capital gains taxes. There's really not a loss. You're not in trouble for not being able to meet these deadlines. You just have to pay the taxes. Next are tax deductions. Basically, it's going to lower your taxable income. All of your rental income counts as passive income. It is a different category than your W-2, your 1099. So all of your losses in real estate cannot go against your income as a physician and offset your taxes. It just doesn't work at the base, at least. There's ways to kind of finesse it though. Some of those deductions that you get to take, it's going to be interest, taxes, insurance, repairs, all the maintenance stuff, traveling. When I drive from one building to another, I can deduct that travel. I can deduct my parts of my car, things like that, all count towards my deductions. I can use that against all the rental income that I'm getting from these properties. So that's where I can do those tax deductions. That's why it's valuable. You make $5,000 of rent, you have enough deductions and depreciation to offset it. You don't pay any taxes on the money that you're putting in your pocket. The last thing for the tax benefit, it's this real estate professional status. It could be you. But you have to follow the rules. That's the tough part. So, requirement 750 hours per year as a minimum. And you have to do that more than anything else you do. I do a lot of real estate. I am doing it constantly. I'm always talking about it. I'm always working on buildings and properties. I will never be able to convince the IRS I spend more time in real estate than I do as a full-time doctor. No matter how I calculate my hours, they will never believe me. I will always be audited. They will always go after me for it. Part-time, you can do it. So one of the things I always joke about is maybe I'm going to go part-time. If I go part-time, all of a sudden I will be a real estate professional. If I make $150,000 as a doctor and I have $100,000 of losses in deductions and depreciation in real estate, I now pay $50,000 in taxes, let alone working, make $300,000 and pay 40% tax rate. The take home, there is a break point of where me working part-time, actually, I make more money take home by being a real estate professional. The benefits of doing it, so the real estate professional can take the losses against your W-2 and your 1099 income. That's why this is such a powerful, powerful thing. Only one spouse has to be it to qualify. So if your spouse does real estate, they can qualify for real estate professional status. They have to have the losses for it to be worthwhile. So they have to be doing a lot of work. But if they've got that losses, you can make a tremendous amount of money back on your taxes by doing it. My wife hates real estate. She's not a real estate professional. That's okay. She has fun doing other things. I pay more in taxes. It just is what it is for now, at least. Here's my example. 400 grand, W-2 income. Use 30% as our tax rate. Make it easy. Your taxes are 120,000. Just what we were talking about. Your take-home pay is now 280. Now, if you have that same $400,000 W-2 income, and you have the same, even if you had $75,000 of losses up here, now you or your spouse is a real estate professional. You're taking that $75,000 off of that 400 grand, your earned income. You're only paying taxes, that 30% rate, on $325,000. So your total tax burden is $97,000 versus before your total taxes were $120,000. So your take home, you're making an extra $22,000 in your pocket at the end of the year. I think we would all love to have $22,000 more on our taxes. $75,000 of losses, it's a lot. It's not something that I normally have year in, year out. But a lot of times I'm taking $20,000, $30,000 of paper losses every year without buying, selling, without doing any of these 1031s, without doing that sort of thing. I'm just generating losses. Biggest thing is the depreciation. That's kind of the biggest benefit of it. It's just, in addition to all the money you're spending on upkeep and maintenance and those things, depreciation is not really costing you anything physically, but you're getting the tax benefit of it. The IRS considers your asset as technically deteriorating. There's homes from the late 1800s that is not a 27 and a half year lifespan.
When you have a real estate or property, it's likely in an LLC. You're paying the self-employment taxes and all that stuff. How does that go into that?
So, number one, you can read all about it on my blog about LLC versus sole proprietorship versus partnership. If it's an LLC, you're not paying any taxes. It's considered a pass-through entity. So this building is in an LLC. I am not paying myself a salary. It's just counted as pass-through income onto my taxes. So the income that it produces is just passive income on my tax return. There is no federal, state, FICA. You don't pay those taxes. It is just passive income.
Is that only for real estate or for other?
It would be for any passive income.
If you purchase a property from someone, likely they're also depreciating it. Does that count towards the 27.5, or you?
The clock starts when you buy it. So losses are great, but again, this is only if somebody is a real estate professional status. But there is an exception because the IRS makes exceptions for everything. So there is a workaround not being a real estate professional. Vacation rentals, short-term rentals. This is the workaround for it. So it's called a short-term rental exemption. It's basically you can use short-term rental losses against your earned income. Just like if you were a real estate professional status, you can use the losses, the depreciation of your short-term rental against that W-2 income without spending 750 hours. You have to materially participate in that. You can't say, I have a short-term rental and I have a property manager who does all the work for me and I never actually go and do it. You're not participating. You can't use that exemption. You still get the normal losses, the normal depreciation. You can't use it against your earned income though. The average length of stay in your short-term rental has to be 7 days or less. You can't have somebody, an average, staying there 2 months, these like medium-term rentals, people that are doing like locums contracts and things like that, and you're renting to them, their average length of stay is usually a month, 2 months, 3 months for some of these like nursing contracts. You're not going to qualify as a short-term rental, at least under the short-term rental exemption that you could otherwise. The benefit of a short-term rental is you're going to get higher rates. So your rental rate, say you're renting out your apartment for $1,500 a month. It's a little low for right now, but it's decent. $1,500 a month is a decent one-bedroom apartment in Wauwatosa. Great. Now, say you're doing a short-term rental. We're renting it out at $200 a night instead, and we're renting out 2/3 of the month. Not anything unreasonable. Now your monthly income is now $4,000 compared to the $1,500 of rent. That's why you see people that'll pay more for a house or a duplex and do a short-term rental, because they're not expecting the $1,500 a month that I am assuming is going to be the rent that I rented at. They're hoping for $4,000 a month. They can value that asset. They can purchase it at a higher price. They're expecting a higher return. Active management's required. Short-term rentals are really time consuming. This space, so it's a co-working space, technically, if I had enough people that were renting by the day or by the week, I could count this as a short-term rental and use that. The problem is most people in a co-working space rent out for a month. So I never qualify. But it takes a lot of work to do a vacation rental. I don't know if anybody knows anyone who does it or has tried it. You're answering the phone calls, you're doing a lot of work trying to fill that up. There's always cleaning expenses. You're making sure that your cleaning company is getting there right after somebody's moving out. You have that turnaround time as low as possible. So you're doing a lot of work to do a short-term rental. There's a lot of times with vacation rentals, it's seasonal. So depending on where you're buying, Alaska in winter, you're not going to have a lot of tourists. So you have to account for kind of a high season and a low season when you're buying these rentals too. So this $4,000 a month, it's just an example more than anything else. Our kind of notable adjacent investments, note investing, it's kind of similar. Basically, you're just buying somebody's loan. So companies will sell a loan. You can just buy somebody's loan. They pay their loan payments to you instead of the bank. You hold that loan. If they default, you can go after whatever asset they have as the collateral for that loan. It's kind of similar to real estate, so I just wanted to mention it. The other is hard money lending. So a lot of people get into this. It's basically similar to like crowdfunding. You are loaning out money, usually a bigger amount though than $5, to one individual person, one individual investor. You're typically getting higher returns. So you're loaning your money out at 8, 12, 15% interest rates. So you're getting a good return on that cash that you're loaning out. Besides, you're also adding points. So 8% over 3 months, and they pay you $1,000 for the privilege of you loaning them their loaning money. That's basically what the hard money is. Again, these are loans that banks don't want to do. Typically, it's people that are flipping properties. So if somebody wants $100,000 to flip a property, they're planning to sell it 3 months down the road, they go to a hard money lender to get the whole cash payment, and then they can sell or refinance at that 3 month once that remodel is all done. It's similar to real estate, so I included it in there. It's something similar to invest in. So these are all the basics of real estate. We could go into each one of those topics in a lot of depth. Like the like-kind exchanges, there's a lot of different things you can do with it, a lot of different rules and things you can kind of finagle. If you made it this far in the video, thank you so much for your time and investing in yourself. My goal with Rounds and Returns is to keep this education free and practical so that you can be able to accomplish all of these things on your own. If you learned anything today, I would really appreciate it if you would like this video and subscribe to the channel. If you have any questions or any topics that you'd like to see in the future, please leave a comment down below and we'll try to get it added to the schedule. Again, thank you so much for your time and attention, and I really hope you have a great day.